Another big red day in the markets. Oh no. But well, check it out. I'm in Connecticut. It's very green here. My way too early call that we already bottomed actually still holds. But what I want to talk about right now, everyone's freaking out about the Fed tightening and freaking about the yield curve inversion. I want to look at charts that show you what's actually happening with those. Yeah, and also the market crash, like the Nasdaq came down and S&P came down with it, but my stocks that I've been talking about did not come down today, and most of them didn't. So I'm gonna show you what I think is gonna lead this rally. I think the rally is happening immediately, and the stocks that are rallying did not come down into this pull. But let's do the yield curve first. So this is the U.S. 10-year minus the U.S. 2-year. Wait, yeah, 10 minus the 2. So this cuts out like the short end, like the 1 month, 3 month, whatever, small treasuries, and it cuts out the 30. So you're just getting the middle of the treasury bond curve. And we are not on log scale. So you can see here, this is the 0 line. That's where you're inverting. When you go below that, that means that they're upside down. Like the 20-year has a worse yield than the 10-year. That's not a good sign. When you're really steep, that means the economy is doing well generally. So the lower you are, the worse you are, and when you invert, it's a big problem. So people said we inverted back here around COVID, and not really. I mean, we just barely poked it. It went flat for a minute, and then we had the whole, repo crisis and all the crazy money, and we had the COVID crash, and whatever, all the MMT government money printing programs, whatever. Anyway, it didn't really invert there, and people said it inverted here, so now we should have a recession like immediately. But this is not. This has just poked it barely. It barely inverted. Let me show you what an actual yield curve inversion looks like, and if this happens, it's actually a lot easier to trade. Like this is just kind of messy. It's like just poked it, but this is not a good trading signal when people are talking about the yield curve. And I'll explain the Fed tightening also after this, because we haven't even started tightening. The big market crashes happen at the end of a Fed tightening cycle, not at the beginning, and we haven't even started it yet. So we just slowed down the printing. But that's just like the Fed giving liquidity to the banks slowed down. But the banks are flush right now, and they can create as much money as they want. So yeah, here, let's go back to like 2008, right? So here we poked it, right? And 2006, then a year later, 2007, 6, 7, we're inverting. See how it's curved when we're inverted down here? And then when you start going vertical out of the inversion, that's when you get the crash. And it wasn't until we made it all the way up here that we got the crash, right, in 2008. So it inverted and it went pretty vertical, and then you get the crash, right? That's an inversion, where it's kind of swoops under the line. It stays inverted for like a year or something usually. Okay, and this is the 2000 crash, right? So look, we had a poke back here in 94, way before, 6 years before, right? And then we poked it again in 98, 2 years before it. Then we inverted, right? And then we start going steep, and then we had the crash as we're going steep, right? So that's what an inversion looks like. And this one went pretty deep, and that was a pretty big crash, and it happened early that time. Right, so that's a yield curve inversion. And if we go back, I don't know how far this chart goes back. Right, like the 1990 kind of recession. Yeah, so we just barely went under, right? And then we came out and just kind of wobbled, right? And the 90s recession was like 90, 91, was a really weak recession, but you can see that it inverted. Then we did have the recession pretty soon after the inversion. So generally, when you start going up from an actual inversion, that is dangerous. But I mean, we're going up from the tiniest little inversion here, and the stock market's been coming down. So that's something to look at, I guess. But that's not like a big yield curve inversion thing that should be concerning a bunch of people. Now, as far as the Fed tightening goes, well, one thing that I always say is the Fed has absolutely no control over the interest rates. They just straight up don't control them. The interest rates are controlled by bond trading. And I showed this last time, but I'll show it again real quick. This is the U.S. Treasury bonds. This is the 20 years. And so this surprised me, this move in the bonds. I was wondering if we're going to break out of this downtrend back here, or if we're just going to kind of go down this line. But, I mean, we're way far away from our downtrend now. And it looks like we're getting a bottoming pattern here. So this tells me that whatever trend we were in is potentially trying to reverse now. But this chart is the one that really matters. This is the Euro-dollar futures, which is the international bond trading market. And the Euro-dollar futures tell you everything you need to know about interest rates. Because what we do on the Euro-dollar market is we bounce back and forth between the deflationary side and the inflationary side. And so this is like a 40-year trend, and it was really steep. Like the inflationary side was like 20% interest rates at one point, and the deflationary side was maybe 8%. Here, let me go to weeklies. This is much easier to see on the weekly charts. Alright, check this. Okay, this is the interest rate basic cycle of interest rates. The Fed is not involved in any way in any part of this graph. This is the international bond trading market, but it tracks exactly. It doesn't track what the interest rates are doing. It tells the interest rates what to do. And all that the Fed does is guess where it's about to go, and they announce like, oh, we want to raise rates because they can watch the chart and they think they're going up. And then when they get it wrong, they're pretty good at it. I mean, they usually get it right, but when they guess wrong, they're like, oh no, it's an emergency rate hike or something. They just like guessed wrong, and then they have to like say that they're moving it over here for blah blah blah. It's all fake. Like the interest rates trade on this chart pretty simply. And you can see back here, this is when interest rates were like 15-20%, and it just keeps like working its way back and forth towards zero. And then when we got to the 2008 bottom at zero for a long time, right? And then the bounce is smaller, right? And then we just went back to zero the last couple of years, and now we're coming up, right? So this, if we stay in this pattern, that's it. Like we're done hiking, and we'll probably go back to zero. That's the most likely thing that happens, is the interest rate hikes are done. They're saying interest rates are going up, but the only way that they keep going up is if the bond market trades out of here. And the only way the bond market is trading out of here is if the world economy is actually improving. Interest rates are not going to go up if the economy is in the tank. And the economy is in the tank, the whole world economy. They're not going up. That's ridiculous. I'm pretty sure they know that. I think they're just screwing with everyone. But yeah, I mean, you just look at the chart here. So, and there's also the risk if we come down that it can actually break to the downside and do a deflationary breakout this way. So, anyway, I think the interest rates are topped right now. Like if they try to announce a higher interest rate next time, they're going to have to probably do an emergency, oh no, let's move them back to zero thing immediately afterwards. That's what I think is going to happen on the interest rates. Like I don't see inflation here. Like if you move out here, this is inflation. We don't have inflation right now. Everyone that's talking about inflation is out of their mind. They're just wrong. What we have is higher prices because we have less stuff being produced and we have more demand to buy stuff. It's just supply and demand, higher prices, and they can come down. Everyone says they can't come down. Yes, they can. But anyway, let's go look at the market. And yeah, what I was saying is the Fed tightening is, well, they're talking about tightening. They haven't started doing it. So this is the inflation and interest rate curve. Everyone's freaking out about that. Nothing dramatic is happening here. It's just still in the same pattern it's been in for 40 years. And the yield curve inversion is, it didn't really invert, but we're getting a pullback after that. So, you know, kind of watch it. It's hard to tell if we're in a bear market or not, but I don't think we are. Let's go look at the S&P. I think we're going to get another big, I think we're going to get another big leg up. And everyone's so bearish, like there's so many puts right now. Everyone thinks crypto is going to collapse. So anyway, we got a good red candle today, and we can compare what's actually happening. So let's go back to the dailies. But yeah, anyway, this is the S&P, and this is the 2008 crash. So this channel is what we've been bulling for, whatever that is. What year is it now? This is old. Like this is a very long, like 13-year something channel. You know, usually you only get 5 to 10 years of bulling before you like fall out of the channel and don't go back to it. But we're still in this channel for now. I put another line in on this cone so that you can see like the area that we're bouncing on top of is actually pretty solid. Not 2 hours dailies. Alright. So we did get a red candle today, and everyone's freaking out, right? Like you can see the zone that I painted here is where I think we're just kind of hanging out. We're getting a tiny green aftermarket candle, so people can freak out a little bit less maybe. But if you come in here, like you can see that we're jumping like right on top of this cone shape. That was the last couple of peaks here. You know, the top of this sort of like cone that we broke out of the top of, we're jumping on top of it now. So if we do break down from here, I'm not saying we won't break down. I'm just saying like this is a ton of support, and it's a really good area to position long. And if it fails, get out of there. Not investment advice, but like I'll be 100% cash trying to figure out what to do if we do like break down. But we haven't broke down yet, and this is a really, really good spot for a bullish rally in everyone's face that they don't expect. Because everyone thinks that the tightening and whatever, all that stuff, and that's just not right. Like, tightening hasn't started. Crashes happen at the end of tightening. The yield curve hasn't really inverted. Like, it just poked it. It could be a year before that happens. It might not even happen because we're so close to zero interest rates anyway. Like, that fundamental might be done with, you know, because we're gonna try to hopefully reverse into an uptrend, which would increase interest rates. But like that could happen now, but I don't see that happening. But in any case, you can see this whole area that we're jumping on top of and testing here is a ton of support. I mean, just the downtrend line, we broke out and jumped on top of our downtrend. So that's just support on the immediate move that we just did. That's support. The 13-year channel, we're jumping right on the top of it. That's support. And also that cone shape that I've just seen some other people pointing that out. That wasn't on my chart before, but anyway, this is not only just an area of support. I tagged this thing before the down move happened, and we were just like right at it. So it's my spot to go long. Like I had this spot picked to go long as soon as it happened anyway. But you can see here, now we've got 4 candles with the bodies dead flat right at this level. Like this 3912 level is a flat bottoming coil level. That's a bullish shape. Yeah, so in any case, I don't know if we start bulling out we could just kind of bounce along the bottom of the channel and do some boring stuff that's kind of bullish. I mean, we could rocket out of here. I don't know. But I think this is going to be a bigger rally than people expect, and I think we're actually going to go to all-time highs. I think this whole area over here that people think is the end of the world is part of the top. I think this is the left shoulder. I think we're going to go to the head. I think this is the left shoulder and we're going to go to the head. And I think it actually might be a bit more steep than people think. Like, I think we're going to get up here and put in an actual top. We might even break out of the top of this channel because we tried to break out here and failed. So, and then we crisscross and check the other side. So we might blow out of the top actually. Like if we're up here, it's going to be interesting. Worry about that later. But you can see we got the big red candle today. People are freaking out. The NASDAQ, right? The big tech stuff put in a big red candle. The NAS is like leading this reddish move down, right? And as I showed before, like the NASDAQ versus the S&P is getting weaker. Like we have this zone kind of where the NASDAQ was overextended. And now we've fallen back in and we're headed down. So this chart just shows that the Nasdaq was getting stronger for like the last 12 years, and it topped, double topped, fell back in, and now the Nasdaq's getting weak versus the S&P. So I expect that trend to continue, and this is nothing weird. Like, this is a completely normal credit cycle thing. Like, at the beginning of a credit cycle, tech and growth bull really hard. When you get near the top, tech and growth will crash before you get to the top. But what rallies when you get near the top is materials, miners, minerals, commodities, stuff like that. And I'm going to go look at those stocks and show you that they didn't come down. I mean, a couple of things, I guess, like gold just chilled. It's at a good spot, but it's not looking super bullish, right? Bitcoin froze where it is. And this is interesting because I'll worry about Bitcoin later, another video. But, I mean, my previous chart on Bitcoin had it crashing. Actually, see this mark I had? I was like, when we break this mark, we're going all the way down. Down to, I don't know, 14 maybe or something like that. But actually, like, what it's doing now, I don't know. Good luck with Bitcoin. But Bitcoin did not crash with the market today. Neither did gold. Neither did silver. I think silver might have rallied a little bit. Right. So, like, the metals, the monetary metals and the commodity metals are looking okay during this awful down day, right? Copper, I think copper did not do as well, but it's just kind of chilling, right? So let me show you a few stocks and what's happening with them, and like what I think will actually work in this next leg. Right, this is Senseonics is a diabetes stock, but it's a different sector than health and growth. It's like kind of my little meme stock that I like to play with. But I mean, you can see this thing rallied. Like, I got this when it caught support here, and it doesn't look that big, but it's a pretty decent rally. You know, in a couple days. And it's not, I mean, it pulled back with the red candle, but it didn't pull back anywhere near the lows. Like, this is rallying, it's a different sector. The semiconductor related stocks are seeming to hold up, like Tesla and some other like EVs and semiconductor related things are interesting. I think this is like new infrastructure kind of territory. But you can see the bottom and the rally here. Like, those are stocks that I bought when it tailed down, like on Thursday. And like FCX is copper mining. Let's check that out. These are the type of stocks that should rally to the end, to the peak of this bubble before we have the actual crash. You know, and of course, if we break down, like, that whole theory is wrong. But just based on today, it looks like it is bottoming, and I think this is a good bottoming area. And these are the type of stocks that are holding up and they're not crashing. And FCX did not do as well. Put in like a decent red candle. So I'm not sure if that's going to be as awesome as I was thinking. Alcoa is aluminum manufacturing. You can see it put in a solid bottom, rallied, didn't really pull back much here. So a lot of these materials, metals, miners, minerals, these are the kind of stocks that rally at the very end of a bull cycle before you go into the bear market. And when you're in the bear market, everything crashes together. Like, these will hold up a little bit better for a while. Like, all the high risk, growth, tech will crash out, but the bonds will crash out with that. Like, everything crashes. When you get into a real bear market, everything's crashing. These will crash less than other things. You get like defensive sectors that crash less, but who wants to be just holding on to stuff that's crashing? I mean, that's kind of ridiculous. Uranium, like things like energy stocks should do well at the end of a market. This is my favorite uranium stock. It's the Uranium Royalty Corp, which has access to several uranium companies without the individual risk being too high. And this is bulled pretty well, and it's maybe a head and shoulders, and so yeah, it's just coiling. So this looks like it's going to make a big move. I don't know which direction, but I mean, if everything holds and these things start going up, this should be bullish. Like, this should be a bullish stock here. And I don't know how high it could bull, but it could get it could get crazy. Like the last leg, the last bull move of a bull market can get very steep and kind of ridiculous. I mean, this stuff could just scream up in your face. Everyone's just thinking like, the Fed's tightening. There's no more free money, all of that stuff. But that's not true. Like the Fed made sure the banks are functional, and they are. The banks are not tight now, and the banks can loan money, and they are. They can loan tons of money into margin, which will blow the markets up. They can loan money for house purchases and stuff and hold the housing bubble up. And yeah, the banks can make money. That's what they do. They print money up as loans, and that's what drives markets. So they're fully capable of doing that right now if they want. AG is a silver stock, and so silver is a commodity that's getting more and more in demand in tech, but it's also partially a monetary metal. So the general idea with silver is if gold is doing well and commodities are doing well, then silver does twice as well. And so this is hitting a very long-term trend line on this stock that, yeah, this thing could pick up and bull. So all of these are stocks that I've either considered going long on or have gone long in the last week and a half. MAG is not as cool. Gato I looked at last time. This one had some problems and like teleported to the downside, but I mean it's so low that this could be a surprise kind of rally stock. In the silver, and like a bunch of these meme stocks that went crazy the last several years, and all the tech, big tech and growth stuff, I think it's just going to not be that good. Like the whole market might rally, those things might rally, but I don't think those will be the ones like exploding on this leg. But we'll have to see kind of how it plays out. Yeah, I think that was about all I wanted to cover today. My way too early catch a falling knife bottom call is still in place, and we'll see if that that flies in my face or not. Probably the next 2 days we'll see what this bottoming area actually looks like. But yeah, anyway, that's an aggressive bottoming call, but it's a pretty obvious one, so I just made it, and if it doesn't work, I'll just get back out and and start over. So that is the market for today, not trading or investment advice, and yeah, good luck. Cheers.